So let's talk a little bit about the banks here. JP Morgan, Citigroup, and Wells Fargo kicked off earnings season with a bang last week. We saw higher interest rates help lift the fortunes of the nation's largest banks. Investors, they have another busy week ahead. Goldman Sachs and Bank of America are set to report their Q3 results on Tuesday before the bell rings. Could big banks set the standard for how earnings season will play out this quarter? Let's bring in Gerard Cassidy, RBC Capital Markets analyst. And Gerard, one of the kind of magical words that we've been looking for, at least as has come up through some of our previous discussions, as we were looking for what would be the tenor this earnings season, was cost discipline. Is there kind of a magic word or a general theme that you expect to prevail over the course of this earnings season?
Yes, there is, in our opinion, and that's all going to do with credit quality. And as you know, the single most important issue for any bank is the trends in credit quality. Now, there's also been, of course, topics such as the unrealized bond losses in their bond portfolios and margin pressure that's developed because deposit rates have moved higher. But in the long run, or when we look out over the next 12 to 18 months, I think it's all going to be focused on credit quality, which today is actually quite strong.
But George, is that something that you think can stay intact? And also going back to what you just mentioned there about deposit rates, we talk about the fact that many of the larger banks obviously in a better position to weather some of that headwind right now. But how does that position some of the smaller, more regional plays?
It's a good question, because when you take a look at credit quality, obviously we all know about the downtown office space in big urban markets. That's a real troubled market. Most of the smaller regional banks are not exposed to that market. They generally have higher exposures to commercial real estate, but it's not in those downtown large office buildings in our big urban markets. And on the deposit side, the real key question, what we have to focus on, is when does the Federal Reserve reach its terminal rate for Fed funds? Because over the last 4 tightening cycles, around 5 to 6 months following the terminal rate for Fed funds, deposit rates stop going up. And that's real positive for the banks, because what happens is the cash flows coming off of the asset side of the balance sheet from securities and loans are reinvested at higher yields, helping their net interest margin expand. So the key question again is, when will the Fed reach its terminal rate? And in the past, that's been a real catalyst for bank stocks to do better.
For banks, especially as you were mentioning some of the dynamic that they're going through right now, where you do have some of the banks that are kind of carrying the most wealthy client base in the assets under management, and you think about what Goldman is potentially going to say, especially given the outflows that we've started to see, at least for some of those bank customers that have said, you know what, I want to sit on the sidelines outside of some of my typical investments now and perhaps go into cash or go into other asset types. Where do you expect that to show up in some of the financial performance?
I think you put your finger on it, because, you know, that old expression, cash is king, I think is coming back when you can earn over 5% on your cash sitting in a money market mutual fund. So I think what you're going to hear from Goldman and others that have the wealth management business is that the inflows are still strong, but they're moving more into cash-like products that have lower margins. The push into equities is kind of softened. And so assets are moving higher, but they're moving more into cash. And we would expect to hear not only Goldman talk about that, but Morgan Stanley as well when they release their numbers this week.
Gerard, I'm curious your perspective on the tone from the bank so far. Obviously, we just heard from 3 of the large banks on Friday. We're going to hear from more this week when we look ahead to Goldman and Morgan Stanley. But what's your assessment and just how that compares to the tone that we heard from management over the last couple of quarters?
What we've seen in terms of the tone, the further we move away from March, the less distressed the tone is. Obviously, with the bank failures in March, and then in the reporting of first quarter results in April, and then second in July, there was concern. There was a lot of uncertainty. But as we move away and the contagion risk has not shown up, I think banks are more confident that as we move forward, more normalcy is going to be coming into their business. But as Jamie Dimon pointed out and you highlighted, we're in a very tough geopolitical environment with this recent outbreak of the conflict in the Middle East. That adds greater risk to the banks, no doubt about it. Now, as you know, our U.S. regionals are not global banks like a J.P. Morgan, but it is very unsettling what's going on, and it's very disruptive, and it could pose, some unfortunate risk for even the regional banks as we go forward. But for the domestic U.S. banking industry, moving further away from March has led to a much better tone on the third quarter calls.
Gerard, we were kind of waiting for what was expected to be the next shoe to drop after the banking crisis earlier this year for some of the regionals that led to some of that consolidation that we did see mid-year. And commercial real estate, that continued to come up in conversation. How much of a risk is that still for the banks right now?
It is probably the most pressing question for the banks. Fortunately, because of the debacle in 1990, the long memories for some of these senior bank executives, the U.S. banking industry, specifically the top 20 banks, they just don't have the exposure to commercial real estate like they had in the 1990 debacle. As a result, it's going to be manageable. That doesn't mean we're not going to see, default, which we are. We've seen Wells Fargo and PNC on Friday lift the reserve for their office commercial real estate portfolio. Those are the loan loss reserves to over 7%, which is very high. And they're preparing to obviously have defaults materialize as we move through this cycle. But in terms of the biggest exposures, it's in the shadow banking industry. It's not in the commercial banks amongst the large banks. In the shadow banking industry, it's the CMBS, the commercial mortgage-backed security portfolios. That's where the risk is. And when you look at some of the high-profile defaults when Brookfield defaulted in Los Angeles, handed back the keys on that big property, Blackstone in New York on the 7th Avenue property, what you're seeing is the banks were not the lenders. It was CMBS. So the CMBS market is the one that's suffering the pain right now rather than the large banks.
So, Gerard, given all this, what's your top pick right now for the sector?
We would say that if you want a large market cap name, Bank of America would be it. They have obviously been underperforming this year. Everybody is concerned about their large unrealized bond losses that they have in their held to maturity portfolio. But I think as rates stabilize, that will become less of a concern. They've got an incredible consumer deposit base. They're one of our premier large lenders here in the United States. On a regional side, we would go with two names. PNC, who we just talked about, reported on Friday. We expect them to continue to grow their franchise nationwide, particularly as they sell more of their commercial banking products into their BBVA acquisition that they completed 2 to 3 years ago. That gives them added growth potential. They also picked off $9 billion or so of loans from the FDIC from the Signature Bank failure, which again is quite positive. And then for Midwest Regional, Fifth Third, about 20 to 22% of the franchise is in the Southeast. The remainder is in the Midwest. And over the long run, the onshoring of America is real, and this company will benefit from that over the long run. But in the meantime, they're growing their consumer business very well. They have a relatively new CEO who's very dynamic and looking to grow this company, well into the next 5 to 10 years.
All right, Gerard Cassidy, always great to get your insight. RBC Capital Markets analyst. Thanks, Gerard.
Thank you.